Are you looking for a way to invest in the stock market with taking a little bit of a higher risk, but finding an easy way to have your investment diversified and manage that way hassle-free? Then this video is one that you're going to be taking a look at. Here in this video, we're going to be talking about an all-in-one exchange traded fund. I'll explain to you what an all-in-one exchange traded fund is and how it can help many investors out there that are looking for an easy way to invest solely in the stock market and getting a little bit more exposure and risk that way for the expectation of higher returns, but doing it more passively without the hassle of having to choose and pick and choose different stocks. So let's get into this video. Several weeks ago, we made a video here on this channel whereby we talked about the all-in-one exchange traded fund concept. And what all-in-one ETFs are, essentially these are selected ETFs, which are a basket of different holdings, including stocks or bonds or different type of investments, options, having it all into one pick and choice for you. By investing in that one ETF, you actually get a good exposure to the underlying holdings within that basket. So let's assume in this case, you are an investor who are more of a risk taker. You want to invest solely in stocks because you expect that the stocks over the long term are going to give you a better return. So you have a couple of options. One is you do your own research and go and pick different stocks, which can be a good way, but at the same time, it can be riskier because you have to find those winning stocks. And as you know, it's not always as easy. And in many cases, many investors who believe that they're going to find that winning stock, they actually fail to do so. Along the way, you might actually end up picking some stocks that really drag down your return for your portfolio. The alternative to that is picking an exchange traded funds, whereby within that exchange traded funds, you get exposure to a basket of different stocks. So let's say there is an exchange traded fund for S&P 500, whereby you are invested in indirectly in the largest 500 stocks in the US. While that's interesting and good, again, it doesn't give you that full diversification because that way you're mainly invested in the US stock market. How about Europe? How about Canada? How about Australia? How about emerging markets or international markets? That's why the other option for you would be then to pick and choose different ETFs that gives you different exposure from different geographic diversification, for example, or different company sizes for that matter, or even different sectors. But the easier solution in this case that we are going to introduce in this video is an all-in-one exchange traded fund, whereby you pick one ETF and easy for you to pick that one, whereby within that one ETF, they consist of multiple ETFs within that, which automatically gives you that exposure and that diversification underneath that. We have made 3 different videos on this channel focusing on all-in-one ETFs for different risk tolerances. We had one for those investors who are very much, going after higher risks. So that was fully focused on 100% stocks ETFs. We've made that video. I'll add a link to the description of the video as well as to a card. We also made one for more balanced investors, whereby you get roughly about 60% exposure to stocks, 40% to bonds and fixed income. And lastly, we also made one video whereby it was more for conservative investors, whereby you are more interested in the passive income and not really that interested in the longer term growth of and appreciation of your investments. Those are the ones that whereby you have closer to 80 to 90% exposure to fixed income and bonds, and only about 10 to 20% exposure to stocks. We've made all those 3 videos and the links are added in the description, so be sure to check them out after you watch this video. But in this one, we are focusing on one specific all-in-one ETF, and that is no other than XEQT, or it's BlackRock iShares Core Equity ETF portfolio. It was one of our picks for the top all-in-one ETFs, whereby you have 100% exposure to stocks. And it's one of my picks. In fact, that's the one that I'm going to be pursuing as part of my Smith Maneuver transformation journey that we are going to be embarking on very soon. We'll make some more videos on that and explain to you what Smith Maneuver is all about, but that's the focus of a different video. In this video, we want to focus on that iShares Core Equity ETF portfolio, tell you why it can be suitable for many investors who are looking for investing in all equity kind of exposure, and what are some of the advantages that XEQT provides. Let's get into it. Or as you can see here, through the BlackRock website, XEQT is iShares Core Equity ETF portfolio. You see the last trading price as well as the performance of this ETF so far this year. In 2021, so far at the time of making the video, this ETF was up 17.6%, which is just remarkable for an ETF, and knowing that you don't have to pick and choose or do a lot of research to pick these ETF. What it does, it is a simple and efficient way to gain exposure to a portfolio of ETFs that is broadly diversified across regions in one convenient package. And it actually does that all through a very low cost. In fact, their management fee is only at 0.18%, which means if you invest $10,000 through XEQT in 1 year, your fee would be only a mere $18. It's very low cost way for you to kind of invest in the stock market, that fully on the actual exposure to the stocks and through a diversified way at a low cost through this ETF. Let's take a look at some of their returns. The XEQT hasn't been actually around for that long. That's why they don't have like a 3-year return data for that. But if you look at their 1-year return, this is as of October 31st. If you go back 1 year from that time, the 1-year return is showing to be over 31%. The return since inception annualized is showing to be at 16.77%. The reason I say annualized because if you look at the cumulative returns, since inception, if you invested in day one that XEQT was around, and that's not been actually that long, you'd see that your return would have been at 41.41%, again, as of end of October 31st, 2021. The 1 month return is for this ETF is at 3.46%, 3 months return at 2.9%, 6 months return is showing to be 8.7%, and as we talked about, the 1-year return is upwards of 31%. Let's take a look at some of the key facts. I mentioned that this ETF hasn't been around for that long. The inception and commencement date for that was August 7th of 2019. It does pay a dividend and distribution we call for these ETFs. The distribution yield is currently showing to be just around shy of 1%. It might go up and down depending on, of course, the prices as well as how the different companies, underlying companies, increase or decrease their dividends. Here, of course, the focus is a lot more on appreciation of your investment. You're not necessarily investing in this ETF for the dividends. In fact, in a way, for many investors who are seeking appreciation, they don't mind lower dividend because in that case, you're actually able to grow your investments faster through the appreciation. And later on down the road, when you are in early retirement or retirement years, that's when you start withdrawing money, and that's when you want to really be taxed on it. Keep in mind, as you get these distributions, you are going to be taxed on that year that you earn those. So for many investors that are not yet retiring, it's probably ideal that they don't want to get taxed yet. You'd rather your money grow tax-free almost, quote unquote, because you're not selling anything, you're just buying and letting it grow. And only at the time later on, let's say that you are retired and you decide that you want to sell it, that's when you don't mind being taxed, because let's say you've already stopped working and you don't have any other income, and you based on depending on your the level of income, there are different tax considerations for you to be mindful of. The distributions are paid on a quarterly basis, and here, if you look at it, there are only 4 holdings underneath that. And it might sound very small, but there's a catch to it. So the 4 holdings underneath here are actually 4 different ETFs that all are with BlackRock. And that's the magic of giving you that diversified exposure to different markets, geographies, and other considerations. So if you look at it, one of the holdings is ITOT, or iShares Core S&P Total US Stock Market. That gives you that close to 48% exposure to the US stock market. You have XIC, which is for Canadian market, that the S&P Toronto Stock Exchange capped composite. So you got about 25% exposure to the Canadian stocks. XEF, which is MSCI EAFE IMI index, that gives you exposure to over 1,500 stocks from Europe, Australia, and Asia, as well as you have iShares Core MSCI Emerging Market that gives you exposure to the emerging markets, many other countries, roughly about 5% exposure here. Pretty much over 99% here exposure is to stocks. The remaining portion is just a minor portion in the cash, such as USD or Canadian dollars. And let's take a look at exposure breakdown by geography. So you see United States is the highest exposure. You get close to 47% here. Canada is around 24%. Japan, United Kingdom, Switzerland, France, Germany, China, Australia, and Netherlands are among the top 10 geographic exposures. And pretty much, if we look at it, these are among the top 10s for you. The rest, they're all bundled up into other, because they are actually consist of many different exposures, but they are a smaller portion that is not actually among your top list to be pointed out here. In terms of asset class, as I mentioned, pretty much almost virtually 100% of your exposures are for the stocks. Let us take a look at some pieces. How about the fees? We talked about low fee. You'd see the management fees at 0.18, but the management expense ratio in total, if you take that into account, is going to come up to 0.20. So overall, that 0.20 is the fee that you need to be kind of aware of, and that's reported in the fund's most recent semi-annual or annual management fee, and includes all management fees that we talked about, as well as any other GST, taxes, as well, or HST, harmonized taxes that you've got to be overall exposed to. What's fascinating here, that although you're fully invested directly in stocks, and typically we know stocks are risky, because you're investing through more diversified exposure through ETFs, overall risk indicator here is marked as low to medium. The question is this, let's say, riskier than, let's say, potentially an ETF whereby you are only invested in fixed income or bonds? Probably, because here there is going to be more volatility. You're invested in stocks, but depending on your risk tolerance, this could be an ideal scenario for many investors, particularly the ones that have higher risk tolerance, or the ones that also are looking for appreciation in terms of their investments, and they have many years, perhaps, or at least perhaps 10 to 15 years at least before their retirement, or when they want to start withdrawing funds from this account. I think that's a good exposure. We talked about the ETF breakdowns, but we didn't take a look at necessarily the holdings. So let's take a look at aggregate underlying holdings. What type of companies are you actually getting exposure to? Do we know even these companies? And you wouldn't be surprised, many of these companies are the ones that you hear all the time about. So on top of our list, you get exposure to Microsoft, which the underlying exposure to it is about 2.5% of this fund is invested in Microsoft. Apple, Shopify, Amazon, Royal Bank of Canada, Toronto-Dominion Bank of Canada, Tesla, Google Alphabet, Brookfield Asset Management, which is a Canadian company in financials, Alphabet Google Class C. We can take a look at show all, and that gives you a full list if that's something that interests you. It's going to take a while for it to load. You can also download the holdings if you want to see the entire details. And this is, for example, as of the time of making the video. It's just loading for us for a while, but yeah, it's actually the page got unresponsive, because take a look at that. They have close to 10,000 different holdings underneath that. I could have probably just click on the second page to show you that. That's fine. While we wait for the page to load, what I would do, I'm going to also take a look at some of the underlying details around business involvement. I know these days many investors are interested in finding ways to invest in companies that are more sustainable, companies that are advocating for sustainability, companies that are not supporting activities such as, let's say, controversial weapons, nuclear weapons, civilian war firearms, etc. What's interesting here, in BlackRock, they have a report on the business involvement of the companies that these are investments are as part of this XEQT. And what you notice here is the fact that actually a very small portion of these investments are actually in such companies. Like, for example, companies that give exposure to, or are involved in controversial weapons is only 0.32% of holdings here that you're getting exposure to, or tobacco, or oil sands, or thermal coal, or UN Global Compact. You can definitely hover over any of these icons and get to know more and find out more, but that's something I wanted to bring to your attention in terms of other piece of data points that might be interesting to you, for you to look at. Here, finally, the page is loaded. Let's take a look. Aside from that, on the list, we can see companies such as Enbridge, FB or Meta Platforms, used to be Facebook, Bank of Nova Scotia, Nvidia, Canadian National Railway, Bank of Montreal, Berkshire Hathaway Class B, Canadian Imperial Bank of Commerce, Canadian Natural Resources, Canadian Pacific Railways, etc., etc. You could see all the details as you hover down, and you can go all the way, and shows you. You see, for many of these, it's almost showing a zero weightage because it's not double decimal, but doesn't mean that you still get exposure to all these companies. It's just that in grand scheme of things, when you have 10,000, close to 10,000 companies in this list, there's going to be minimal fraction of holdings here, but in grand scheme of things, of course, you're getting exposure to these companies, so don't worry about that. And you see what sector they are part of. You get even that sector breakdown and sector kind of exposure through that as well. There you go. It is the entire list that you can take a look at and get more familiar with. I hope you found this video beneficial and gained something of value from it. If you did, please be sure to give this video a thumbs up and let me know what you think. Are you invested in any exchange traded funds? What are your top exchange traded fund picks? I would love to hear from you, so be sure to leave me a comment down below and let me know what you think. Don't forget, by the way, to subscribe to Moementum channel. Here on Moementum Finance, we post every week several videos about investing in the stock market, as well as ways to reach financial freedom. We talk also about investing in other avenues such as cryptocurrencies, real estate, and soon discussing ways to take advantage of Smith maneuver, particularly for those investors or individuals that live in Canada. Regardless, thank you so much for watching this video, and I hope to see you next time.